Markets move when people move together, and understanding that early is the real advantage. When we move together, we shape outcomes, build wealth, and secure a safer future. The US equity market showed resilience, with the S&P 500 edging up 0.3%, while the Nasdaq Composite slipped 0.2%. Investors remained cautious amid persistent inflation data and mixed corporate earnings. The Dow Jones Industrial Average gained 0.5%, supported by industrials and energy names. Expect continued volatility as markets digest inflation signals and earnings updates. Defensive sectors may hold up better in the near term, while tech faces headwinds from rising rates. Inflation data remained sticky, with the latest CPI report showing a modest decline but still above the Fed's 2% target. The Federal Reserve's messaging suggests a patient approach, but markets are pricing in a chance of further rate hikes later this year. Bond yields ticked higher, pressuring growth stocks. Focus on sectors that benefit from a moderate inflation environment. Inflation-sensitive assets and value sectors could outperform if the Fed continues gradual tightening. Energy stocks outperformed, driven by a 3% jump in crude oil prices amid renewed geopolitical tensions in the Middle East. Major oil producers posted strong earnings beats, lifting the sector. This momentum helped lift the broader market, offsetting weakness in other areas. Energy remains a key area to watch as geopolitical risks sustain price support. Exposure here offers a hedge against inflation and market volatility. Tech stocks lagged, pressured by rising 10-year Treasury yields, which climbed to 4.1%. Several large-cap tech companies issued cautious guidance, citing supply chain challenges and cautious consumer demand. This weighed on the Nasdaq and growth-oriented ETFs. Tech remains vulnerable to rising rates and earnings uncertainty. Consider trimming exposure or hedging ahead of key earnings and Fed meetings. Financial stocks gained as higher yields improved net interest margins. Banks reported solid loan growth and stable credit quality, supporting a positive outlook for the sector. Rising rates typically benefit financials, making them attractive on a relative basis. Financials appear well positioned in the current rate environment. This sector could outperform if rates continue trending upward. Consumer discretionary stocks underperformed amid concerns about slowing consumer spending and inflationary pressure on household budgets. Retailers issued cautious outlooks, reflecting uncertainty over demand sustainability in the face of rising prices. Be cautious on discretionary names as consumer resilience is tested. Defensive consumer staples could provide better downside protection. Overall risk sentiment remains mixed but slightly tilted toward risk-off. Volatility has increased as investors weigh inflation, Fed policy, and geopolitical risks. Safe havens like gold and treasury bonds have seen inflows, while growth stocks face selling pressure. Maintain balanced exposure with a tilt toward quality and income-generating assets. Monitor volatility as a key signal for risk appetite shifts. Chevron stands out with strong earnings and positive outlook amid higher oil prices. The company's disciplined capital spending and robust cash flow position it well to reward shareholders. This strength is a clear reflection of the energy sector's resilience in volatile markets. Chevron is a compelling play on sustained energy price strength and solid fundamentals. Monitor crude prices as a key driver for continued momentum. Tesla pulled back after missing delivery targets and issuing softer guidance amid supply chain constraints. The stock's volatility reflects broader tech weakness and investor caution on growth execution. This highlights ongoing risks in high-growth, capital-intensive sectors. Tesla's near-term outlook remains challenging as supply issues persist. Watch for signs of operational improvement or further softness in guidance. Highest conviction setup, CVX. Chevron benefits from higher oil prices and geopolitical tensions that support energy prices. The company's disciplined spending and strong cash flow provide a solid foundation for shareholder returns, making it a reliable sector leader. Expect Chevron to maintain its upward momentum, supported by sustained crude prices and positive sector sentiment. Short-term volatility may occur, but the underlying fundamentals point to continued strength. If this breaks, a sharp drop in oil prices below key support levels, or a resolution in geopolitical tensions that removes the risk premium, could weaken Chevron's outlook. What happens next? Markets will likely remain choppy with continued rotation between growth and value sectors. Inflation data and Fed commentary will drive near-term moves, with energy and financials poised to outperform under current conditions. An unexpected hawkish Fed pivot or a significant geopolitical escalation could trigger a broader risk-off sell-off, pressuring equities and lifting safe havens further. Tomorrow watch, upcoming CPI and PPI inflation reports, Fed speakers' tone on rate policy, crude oil price movements and geopolitical developments, earnings updates from major tech companies, Treasury yield trends, especially 2- and 10-year notes, volatility index, VIX, shifts and option market activity. Markets move when people move together, and understanding that early is the real advantage. When we move together, we shape outcomes, build wealth, and secure a safer future. Real wealth starts with discipline, health, and strong relationships. Take care of yourself. Take care of the people you love. Stay focused, keep learning, and stay informed. Until next time.